This company has quietly been growing at an impressive rate. In 2024, for example, they did 730 million in revenues. That's a 5-year CAGR of 16%. Trust me when I tell you there's not a lot of companies that have a 5-year CAGR of 16%. So the S&P TSX Small Cap Index had an extremely strong 2025, one of the best years that I've seen in a long, long time. The index was up approximately 15%, and that followed a very strong 2024 where the index was up 18%. We saw very strong commodity prices that were boosted by a weak or weakening US dollar, lots of geopolitical risks. And then, of course, let's not forget back in February, March, all of the uncertainty that surrounded Trump's tariffs. That certainly provided a boost to gold and other hard assets as the market tried to move away for a period of time, financial assets. That momentum carried out throughout the rest of the year, and it certainly shone very well on the Canadian small cap market, which tends to be heavily weighted to resources and particularly minerals. To put that in perspective, minerals are now 40% of the index. Energy is another 22% of the index. So that means almost 2/3 of the index, or more specifically 62% of the benchmark, is resources. Here at NCM, we tend to take a much longer term view when thinking about small caps. We have a disciplined and repeatable investment methodology that tends to focus more on high quality, well-balanced businesses that are not necessarily businesses that are overweight the resource segment of the market. So we see tailwinds primarily from monetary easing and the all-important factor, which is increasing earnings. I think the underappreciated rally here in Canada still has momentum. We have strong commodity prices, we have these very impressive nation-building projects, and a very resilient consumer in Canada that should continue to support the equity market. Down south in the US, GDP keeps ratcheting higher. AI, CapEx, tax refunds all positively support growth. The price at the gas pumps, you're seeing robust airport travel, same-store sales growth at retailers tend to be very strong, all signaling a very healthy consumer. So we believe that the Federal Reserve in the US, in fact, the central banks in many parts of the world have struck a really good balance between an interest rate that is fostering growth and is promoting an easing policy, but not at the expense of resurgence in inflation. And so from a global perspective, this synchronized easing and monetary conditionings should help continue a market that is biased to going higher. In fact, most central banks around the world have been easing, and recall that it takes a good 6 to 12 months for the benefits of that easing to turn into a tailwind, which from a timing perspective lands squarely in 2026. The Small Companies Fund and our Income Growth Funds, which are our two small cap focused mandates, are positioned similarly to the way they were positioned in 2025. They're invested in growth companies that have very, very attractive valuations, in my opinion. They tend to be overweight industrials, not necessarily because industrials will outperform, or we think that the industry will outperform, but because of the specific growth opportunities of these companies that just happen to fit within this category. In fact, both funds are really focused in on the individual attractiveness of the companies in this industry. We tend to really like companies that have a growing a dividend. So, these companies tend to be low PE, high return on equity, strong free cash flow momentum. Many of these companies pay a dividend and a growing dividend. And that their payout ratio, meaning the amount of their free cash flow they're using to finance the dividend, is a relatively small percentage relative to other large cap companies that, might be in industries where a very large percentage of their payout ratio gets used to paying for that dividend. Let me give you an example. We own a company called Black Diamond Incorporated. It's about a $1 billion market cap company. It's owned both in income growth and small companies funds, and it provides turnkey workforce accommodations and modular space solutions for clients. And if you think of the need to build new mines in this country and many other first world countries, whether it be copper, rare earth minerals, gold, or other valuable commodities, few companies can do it better than Black Diamond can. Much like many businesses, as utilization of these assets increase, so does their profitability. The same thing with Black Diamond. We're seeing an increase in the utilization of their business, and we've also seen a very impressive track record over the last few years. And let me give you just a few examples of that. We see revenue increasing significantly, we see EBITDA increasing, and we see earnings increasing, all of which should be a benefit to its market cap. So another idea that may be interesting to our viewers is a company called Jameson Wellness. And if you're like me, getting older means thinking about your health. Jameson is a global health and wellness company. It has a leadership position in vitamins, minerals, supplements, that has been in business for over 100 years. This company has quietly been growing at an impressive rate. In 2024, for example, they did $730 million in revenues. That's a 5-year CAGR of 16%. Trust me when I tell you there's not a lot of companies that have a 5-year CAGR of 16%. EBITDA was $141 million in 2024. That's a 12.5% 5-year CAGR. And earnings was $1.61 at the end of 2024, an 8.5% CAGR. And CAGR stands for compound annual growth rate. We also like that this company is a dividend grower. The dividend was increased to 80 cents a share, making the 5-year rate of growth in their dividend 17%. You may recognize their brands. The brands are Jameson's and U-Theory, and they're some of the most trusted brands at the pharmacy. And as the population ages in North America, they're growing their business endeavors in China, and other international opportunities crystallize. We think that the company will be able to capture more of this large and growing addressable market. So both income growth and small companies have benefited from strength in Canadian small caps recently. We think this asset class looks attractive, especially for those segments that have not participated as robustly as the resource segment has recently. So when we look at valuations, they look attractive. When we look at growth, looks very attractive. And the market is still receiving multiple takeover offers of some of our best small cap companies. And as I often say, if Canadians aren't willing to properly put a value on these small businesses, then their competitors will. And if their competitors don't, then private equity will. And we're seeing that play out over and over. And the great thing about these two products is that many of their investments are really niche companies that don't tend to trade purely on macro themes and instead trade on company-specific growth and opportunities. They tend to trade at a better combination, in my opinion, of value and growth, and provide investors access to the largest equity class in terms of the number of investment opportunities. Very few other asset classes give you these kind of opportunities.